And hello, everyone. This is yours truly, Michael Stewart, with another Money Matters 101 uh, video session on learning how to invest in the stock market. Now, I know some people are still a bit apprehensive about investing in the stock market for fear that they are going to lose all of their investment, and understandably so. But when you have a volatile stock market, you should not let that cause you to be afraid to participate. As we have also already discussed and shown that wealth is gained through investing in the stock market. And there is a disproportionate a number of our people who are not actively participating in that process of gaining wealth. In my last video, we talked about the three major ways that wealth is acquired, and number one being the stock market. But yet, we find that a lot of our people are absolutely afraid to get involved in the stock market. But yet, people want more money. But you got to be willing to do the things that the wealthy are doing to see the gains that they are seeing. Remember, I showed you all a slide that spoke to Warren Buffett and how he amassed his wealth, a great deal of his wealth, and how what he thinks about the stock market and those who would participate in it. Pretty much he said, when people are greedy, then be fearful. But when people are fearful, then be greedy. And so this is true as it relates to the stock market. Um, and so on today's segment, I talk a little bit about how a share of stock is purchased, just to add some clarity for those who may still be questioning, well, how exactly, do I buy shares of stock on the market? And so remember, I showed you all my E-Trade portfolio. Now, some nice things has happened since the last time that I shared that particular portfolio with you all. Remember, I did 3 online stock purchases over the weekend while you were viewing, and it had a positive impact on my portfolio overall. And then I did make a few more stock purchases throughout this week, and I'm going to be making a couple of more than likely before the week is over. And so the key is, you do a little bit at a time, a little bit here, a little bit there, and just keep a watchful eye to see how things are moving along. And I'm excited because on that particular portfolio, the E-Trade portfolio, back in, what was it, May, is when I actually did my first transaction. I had roughly about $64 worth of stocks back in May. That was the total asset value of my portfolio then. And that was about around the first or second week of May. Well, as of today, when I checked it again, as of today, I'm running a little bit over $1,000, and this is just, again, doing some very conservative buying. I am going to be getting a bit more aggressive here shortly. There's a few more gold stocks that I'm getting ready to add to my portfolio. I think there was about 5 or 6 gold mining companies that I was looking at, and I'm getting ready to add them to the portfolio. And their stocks are reasonably priced. Again, I look for stocks that are reasonably priced, and I also look to see where they are at in terms of their performance. So I'll put them on my watch list first and kind of watch them, and then I'll look at their chart to see, if I can identify a pattern of how that stock performs before I pull the trigger, so to say. Now, those that are already very, very low, um, I jumped right on those. I jumped right on those. There was one that was trading at 22 cents a share. And so I went on and bought 10 shares just right off the back. And so they actually have brought me some gain as well. So let's talk about how a share of stock is purchased. There's a number of ways that you can actually buy stocks. You can either do it, you can do a purchase through a broker, or you can do it in person. Now, a broker, of course, is going to be someone that this is their area of expertise. They have gotten the formal training to be a financial advisor and to be a stockbroker. And they monitor and watch stocks all throughout the day, every day of the week. And so you can purchase stocks that way, or you can purchase stocks in person as well. You can also purchase stocks over the phone or online. So there's a number of ways that you can buy a stock. Some examples might include, for instance, I used to work for Merrill Lynch. Charles Schwab is still around as well. And now you've got different other independent companies that have sprung up and have really grown over the years. TD Trade, E-Trade, and then they've got all these different apps as well. So, you know, the popular online brokers are E-Trade and Ameritrade. Excuse me. I like E-Trade. I started out with them, and I like the way the platform is set up. It's very easy to navigate, and there's a lot of beneficial features to these online platforms. E-Trade in particular, they even have an educational section where you can learn as much as you want to learn about stocks and stock trading. And so, and the language is very easy to comprehend. And I like that. They help you understand the terminology associated with the stock arena. And so I use E-Trade. I'm very comfortable with E-Trade. Ameritrade is equally a good online stock trading platform as well. Easy to navigate, easy to use. You know, so there's options available to you if you want to do a little bit of searching around, see, you know, what appeals to you. But I like E-Trade. You can also buy stocks through apps. There are apps, you know, Cash App even. You can even buy stocks through Cash App. You know, now they are somewhat limited in as far as whether or not you'll be able to buy all of the available stocks that are out there, but it's a good starting place for someone that wants to start off small, start off light, not dive all the way in. You've got some stocks that they, you know, for $1 a share, so they make it real easy for you to begin trading. Stash is another app. Acorn and Robinhood. Now, I've not tried any of these apps in particular. Most of what in fact, all of what I am doing in terms of buying stocks right now is online through E-Trade. But I hear good reviews about Acorn. There's some pros and there are some cons, as with anything. But I hear good reviews about Acorn. I hear good reviews about Stash. And I hear some good reviews about Robinhood as well. So, I mean, you know, hey, just, you know, take a look at them, see if they appeal to you, and, you know, start somewhere. Doesn't matter where you start, so long as you get started, right? Then you can also buy shares of stock as a gift. You know, you probably didn't know that you can do that. You can buy shares of stock as a gift. In fact, here's a website that you can go to. It's called giveashare.com. Give a Share is all one word. Giveashare.com. And they allow you to frame the stock as well. The added cost makes it more of a symbolic investment than a practical one. And so if you wanted to do that for a family member, say for a grandchild, makes for a great birthday present, or you know, Christmas present. You know, you can also open an Ameritrade or an E-Trade account on behalf of your children. And so this is where, I really put some emphasis here, as also does Dr. Boyce Watkins. He's got some outstanding programs that you really should take a look at and consider enrolling in the courses that he provides. Now, mind you, he is a professor, uh, and his area of expertise is in finances, and he understands the psychology behind people and finances. So I would encourage you to, if you have not already acquainted yourself with Dr. Boyce Watkins programs through the Black Business School, by all means, it don't hurt to take a look, you know. So you can open up, an account online. E-Trade and Ameritrade are free accounts. I don't pay any fees to be able to participate on that account, and I like that. Opening up an account on behalf of your children, that's a great thing. If you've got young children, you can get them started early. You open up the account on their behalf, you fund the account, and when you make stock purchases, it's a good practice to have them right there with you, explain to them what you're doing so that they can see it in real time. And you'd be surprised what it will do for a young person, when you show them how to buy a stock, especially say for instance, there's a particular product that they like, and it could be a toy, it could be clothing, it could be footwear, it could be anything that they are familiar with the name of that company. And then you go on to the online account and you pull up the stock symbol for that company, and now you can show them, that by buying shares of stock of a company whose products that they use, that they now become a part owner of that company. That does something for a young person. I kind of wish that my childhood started off that way. So I'm kind of behind the eight ball, but that's fine. Like I said, get started. It doesn't matter too much how late it is that you get started. Just get started. Start somewhere. You can also buy stocks directly from some companies. Now, not all companies allow for that, but in limited cases, there are some companies where you can buy stock directly from the company itself. I know years back when I was first involved in the stock market, all of my utilities, that's how I bought their stocks. Those who supplied my apartment with electricity and gas and what have you, they were selling stock direct from the company. You can go right to their website and buy stock. And there's a few companies that still do that. The cases are limited, however, but there are a few that still do that. So when can you buy stock directly from a company? Well, these are called direct stock purchase plans. That's what they're called. Companies will typically charge no commissions in order to be able to do this. So you buy it outright, and there's no brokerage fees, there's no commissions that you're paying. And so they make it affordable that way, those companies that do that. Now, I don't know of many right now, offhand, off the top of my head, that do direct stock purchases as a direct stock purchase plan. So you'd have to, do a little bit of research and, just go to a company, scroll all, usually it's all the way down in the global footer of that page for that website. And you'll see the words investors. And generally that's where you will find that information. If they are offering stock direct, if you click on that where it says investors for any particular company, very well may be one that sells stock directly, and then, usually they automatically reinvest your dividends. So as your stock earns dividends, rather than send that out to you in the form of a check or an electronic deposit, they generally are set up to automatically reinvest those dividends back into more shares for that stock. So you'd be buying shares of that stock in very small increments, over time. Then there's what is called DRIPs. Now, DRIPs are the acronym for dividend investment plans. So this is another way to buy stocks directly from a company, is through a dividend reinvestment plan. So rather than issuing your dividend to you in a check, like I said, the money will go right back towards purchasing additional shares of that same stock within that company. And so they call those DRIPs. That's what that is called. Now, you do have to sign up for that type of a program, and you can buy the shares either directly from the company or through a broker. You still have that option as well. And then there's another way where it's called an employee stock ownership plan, ESOPs, ESOPS. An employee stock ownership plan is another way that you can buy stock directly from the company. Some companies actually allow their employees to buy their shares at a discount. So if you work for a company that offers shares of stock direct, I would encourage you, the company, you're working for the company, why not make some additional monies through their stock by being a stock owner? You're typically limited in the number of shares that you can buy, but the thing of it is that once you reach that limit and you hold on to those shares, as the company does well and end the year with profitability, you share in that profitability in the form of dividends and so why not take advantage of that? But you do want to be careful, because what you don't want to happen is you don't want to have an Enron problem. And so if you remember the Enron situation, you want to be very, very careful of that. Insider trading is against the law. It is illegal. And so you don't want to get caught up in an insider trading situation. So vet everything. I vet everything. I don't just jump right on. I'm going to go through a process of due diligence and checking it out and making sure that I'm not making a foolish decision. So, a question: what happens when you place your order for a share of stock? What exactly happens? Sometimes that may seem somewhat hidden, where people don't understand what that process looks like when you place an order for a share of stock. Now, when I used to work at Merrill Lynch, as I told you, I think in my first session, when I worked at Merrill Lynch, I was a pneumatic tube clerk. And so back then, now we're talking about the early to mid 80s, back then in the sales department there at Merrill Lynch, folks would call in a stock order over the phone. They would call their account broker and they would tell their account broker, hey, I want to purchase X amount of shares of this particular stock. And then the account broker would write the order up. They would write the order up and put it into a tube. If you remember the pneumatic tubes, some banks still have them. You go through the drive-through section of the bank, and there's a box there, and you put your check in the box, your signed check in the box, and you put it in this tube, and it's sucked up. Well, that's a pneumatic tube. That's what that is. And so that's how they would do the transaction. They would write the order out, and they would put the order ticket inside the tube, and they would stick it into the pneumatic system, and boom, it would come through over on my side where I was at, the pneumatic reception area, and a little bell would chime off as one drops down. And I think that row had about 20 slots, 20 or more slots. And so each one had its own bell, and sometimes that thing be chiming off, like ding, 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 ding. And, I worked that by myself, so I'm running up and down, getting those stock purchase orders or stock sell orders. And then I timestamped them, and then I would give them to the data entry clerk. And then the data entry clerk would put it in the system. So I'm describing a very archaic process. It's a lot quicker now. It's a lot smoother now. They've worked out a lot of the kinks, So for instance, when I do a trade via my E-Trade portfolio, those of you that was on that session and saw me do a live purchase you saw it was rather quick, you know, and so that's another way that you can do that. So the process has been streamlined. It's very quick. It happens, you know, in real time. So, you know, you can open up your brokerage account by making a deposit. So I've set it up to where um, I have linked my checking account to my investment account. So when I need to transfer money, it's a quick process. I just, you know, click a few buttons, put in the amount that I want transferred, tell them what date I want to make the transfer, and then the money is electronically transferred from my checking account into my investment account. And so then begins the process. So now I have money in my investment account. And so now I know what stock I want to purchase. I know how many shares of that stock I want to purchase. And so what I do is I pull that particular stock up. Now, if it's not already on my watch list, if it's not one that I've been watching, then, you know, if I'm going to pull the trigger on that one, it's because I've already read some good things about that stock and that I want to go ahead and get it and have it in my portfolio. So once I pull that particular stock up by its stock symbol, the way it's set up on E-Trade over on the right-hand side, there's two buttons. One is the buy button. The other one is the sell button. I click on the buy button, and then I go ahead and I make an entry of how many shares I want to buy. I look at how much a share of that particular stock costs, make sure that I have ample enough in my investment account to cover the purchase, right? So then I place the order by doing it that way. And now the thing of it is that I purchase at the market price. So generally, I transact the first part of the morning, or the majority of my stock purchases have been during the weekend, so that I want to see where did that stock close in terms of cost per share. When the market closes at about 4 o'clock in the afternoon, late afternoon, uh, you can still buy or sell shares of stock, but the transaction is not completed until the market opens up, and then the process begins for you. So I typically do mines during the weekend. So come first thing Monday morning when the market opens, I elect to purchase at market. Now, if it closed, say for instance, if the shares of a stock closed at $4.50 a share, and it allows me to place it as a market order, then come Monday morning when the market opens, then more than likely my transaction is going to be a successful execution, because it's going to open where it closed. So there's the likelihood that I'm going to get it at that price is good, it's favorable, right? Now, so just because you do place an order, that doesn't mean that you own the shares yet, because you got to wait for that order to execute. So here's what happens, and you know, when you place that order for that particular stock, then when the market opens, someone physically goes down to the floor and trades that stock on your behalf. So they're on the floor with your stock purchase order. And if you've ever visited the market to see a live trade, it is a volatile environment. There's a lot of people down there, and you hear them yelling out, "Give me 10 shares off," you know? And so you have to wait for that to happen for it to be considered executed, right? So your order is not guaranteed until it has been confirmed. And that may take a few minutes, okay? It may take a few minutes for it to be confirmed, and then it's considered to have been executed, and now you own shares of that stock. The price of the stock might also change during that time, and that would stop it from being executed unless it's a type of a stock whose shares you can purchase as a limit order. And so I have a few of those in my portfolio that rather than purchasing at a market order, they recommend purchasing as a limit order. And so just to give you an idea of what a limit order is, when you're buying stock, Say for instance, that same stock, it closed at $4.50 at the close of the market. It was at $4.50 a share, right? And we don't know between Friday afternoon till Monday morning what is going to transpire that would affect the cost of that stock, you know, because the stock is affected by what's going on in the economy, right? So let's say I want to get that particular stock and it was at $4.50, but there's a potential that it can go down or it can go up, right? So if I'm buying it, then I have to ask myself, if it does go up by time my order is being processed and being executed, how much am I willing to pay if it goes up? So let's say if it's at $4.50 a share and it can go up, like when the market opens, then I might put it in as a limit order at $5 a share, or I might put it in at $4.75 a share. That's only saying that if it does go up when the market opens, right, that I am willing to pay an extra 25 cents a share for that particular stock and nothing beyond that. If it goes past $4.75, then the order is not going to execute, okay? And I don't own those shares of stock, right? But if it stays at $4.50, then I'm good. I'm good. So it kind of sets a window, if you can understand that. It sets a window that says if it's $4.50 or if it gets up to $4.75, execute that order for me. If it goes beyond $4.75, don't execute that order. I'll reconsider and I may wait and see if it's going to go back down, right? So those are the things that you want to be, mindful of when buying shares of stock. If it tells you that you have to purchase it as a limit order, that's what it's asking you to do. It's asking you to set the limit. How much are you willing to pay above what it may have closed at or where it may presently be at, okay? So I hope that I didn't confuse you with that explanation. If I did, just leave me a comment and I'll respond to your comments, okay? So now there's two basic types of stock market orders that you can place. One is called a market order, which I just explained, where you pay whatever the price of that stock is worth when the order is being executed. And that can be a little risky because if the stock price is changing rapidly, it could change while you are putting that order in. So, that can happen. So far, I've not experienced that while trying to transact a purchase. I've not seen that because, as I said, the majority of my stock purchases has been during the weekend. So that first thing Monday morning when the market opens, I have a greater likelihood of a successful execution at that cost that it closed out at. So a limit order, as I said, you determine the maximum or the minimum price that you're willing to buy or sell that stock. You determine that, right? You can also set a time limit for the stock to reach that price, say like 24 hours. So if you're doing this on a weekday and you're setting a limit, you can also set the time limit for that. So if you're saying that, okay, so within 24 hours, if this stock doesn't, if it's not at a favorable price within the limit that I set, don't buy it. Don't execute that transaction, right? And so when you set that time limit, you have the ability to do that. That also helps you to avoid surprise losses as well. Okay, so that's a good feature when you're doing limit orders. Okay, so when I showed you my portfolio, I showed you how to pretty much analyze a stop quote. How to analyze that. I look at the highs and the lows, 52-week high, there's 52 weeks in a year, right? And so I look at the highs and the lows for a 52-week time frame. I want to see how has this stock performed throughout a year, the previous year. How did it perform? What was its highest point and what was its lowest point, right? And so, of course, I want to make sure that I'm looking at the right stock. So it's important to know the stock symbol, what they call the ticker symbol. Usually it's a 3 or 4 character symbol of letters. And you can easily find that out by simply just doing a Google search, typing in the Google search bar, what is the stock symbol for, and then you, whatever the name of the company is. So let's say we were looking for the stock symbol for Amazon, right? You would type in, what is the stock symbol for Amazon? And it's going to give you the stock symbol, and that's what you want. And so when you go back to your trading platform, you put that symbol in, and then it's going to pull that particular stock up. And so, yeah, you want to look at the 52-week high. You want to look at the 52-week low. Some stocks do pay out dividends. So that there'll be a number there showing the amount of the dividends that's paid out for the year. Then the next set of numbers generally is going to be the percentage, how much is what they call the yield. Okay. And so if it's black or green, that means that it yielded an increase percentage wise. It yielded an increase. If it happens to be red, that just simply means that there was some loss. That's what that means. There'll be a percentage there, but it was some loss. It may have been lower than anticipated because the price went down, what have you. And then the next is going to be the price to earnings ratio. That's a number that investors pay close attention to when they're looking at the price to earnings ratio. That speaks to, investors see that as a gauging tool for whether or not they're willing to pay above the actual value of that stock. And it could be because, they've got some information that, this stock is poised to do very well over the long haul. Down the line, this stock the company is going to be in a real good, profitable position. And so investors would be willing to pay more than what the stock is actually valued at, right? And then the next column over, when you're looking at it, is going to tell you how many volumes have traded, then you'll see the highs and you'll see the lows as well. Each day a certain number of volumes of that stock trades. And so it kind of lets you know how much activity is going on with that particular stock. And then it's going to show you where it closed at the end of the year. Because remember, we're doing the 52-week look. You're looking at it throughout the course of a whole year. And so then you want to see, how did it close out that year, right? And the last column is going to tell you what the net change is, whether it was in the negative or was it positive. Now, if it's positive, that's growth. I don't, the numbers don't have to be very big for me to recognize that that's growth. It could be a net change of 0.21, and some would say, well, that's not a whole lot. Well, no, it's not, but it's more than what was there. It's just like, when I'm walking about, sometimes I happen to look down and I see a penny, I see a nickel, I see a quarter or a dime. I'm prone to pick it up. I'm prone to pick it up, and I'll bring it home and I'll put it in my little widow's mite jug, so that's a few cents more than what I had in there. I see it as increase, and so if it's on the plus side, that's a good thing. You want to see things on the plus side, so those are things that you would look at, that you could look at. I look at that when I'm trying to educate myself on a stock that I'm not familiar with. I'll look up the company. I'll read a little bit about the company, find out who they are, what are their products, their services, or their goods. And, I'll get some information on whether or not they're profitable. And then I'll take a look at their stock and see whether or not I want to buy that stock, right? So those are things that are important to know. And I would encourage you to just practice, just randomly pick a company, find out its stock symbol, and then go on a platform, pull up that stock and just take a look at what's there, right? And so Your dividends are generally paid out quarterly or annually. Um, Annual dividend payments divided by the number of shares that are outstanding. Your yield, your dividend yield, that's your annual dividend divided by the price per share. Your price earnings ratio, we talked about that. Your volume is the number of shares that's traded, and that's usually in the hundreds. When you see a P/E, that's price earnings ratio. And when you see that, um, that's what that is. Okay, the volume now, volume is the number of shares that was traded, and usually that number represents in the hundreds. Okay, so it doesn't mean that it don't go into the thousands. When you see a single or double digits, triple digits, it's talking hundreds, and then it goes up. Okay. Your high lows, your highest, your lowest stock prices are from the previous day, the previous year. If you're looking at the whole year, you're looking at it daily. You want to take a look at that. That's how I gauge a stock, actually. I'll start off, I'll look at one day's trade. What was the high? What was the low? Where did it open? Where did it close? Those are the four things that I look at right away when I'm considering a stock. I look at, okay, when the market opened, what was the price of the stock? Because that price can change throughout the day, right? And then the next thing I want to see is what was the highest point that stock traded at during the day. Okay. Then the next thing I want to know is what was the lowest price that stock reached during the day, right? And then the last thing I want to know is at what price did the stock close at? When the market closed, what was the price of the stock at close? And then I'm doing comparisons now. I want to see how close to the lowest was that stock at close, and how close was it to the highest was that price of stock when it closed. I'm looking at those things to gauge whether or not this stock appeals to me. Now, if it appeals to me, if I like what I see, then I'm going to take a look at a 5-day look of how that stock performed over 5 days. Now, I'm looking for a pattern when I do that. When I look at it over a period of 5 days, I'm looking for a pattern. I'm trying to gauge at what time of the week, what point within a 5-day period did this stock begin to climb, or the price of the stock began to climb, right? And then I'm looking at what point of time during a 5-day period did the price of the stock go down. Okay, so again, that is in relativity to the highs and the lows of the price of the stock. Now, once I've looked at that, right, I could pull the trigger at that point. I could, but me, I go another step. And so after I've done a 5-day, now I want to do a month. I want to take a look at that stock and see how it performed, because I'm trying to establish whether or not there is a consistent pattern that I can gauge the probability of what this stock may or may not do, right? So I look at it now for a month, and I'm looking again for the highs, the lows. At what point within the month did the price start going up, and at what point did the price go down? And I want to see how far down did it go? Did it bottom out, or did it just go down a little bit and then kind of level out and then come back up? That's what I'm looking at. Now some may say, oh my gosh, that's a whole lot. Well, if I'm going to hold this stock for a minimum of 10 years, I want to know, is there a observable pattern that will help me make that decision that this is a stock that I would be comfortable with holding for a minimum of 10 years, knowing that it has a track record of going up and down, but it's pretty consistent. and going up and down because it's a strong company. It's a company that experiences good profitability at the end of each fiscal year. And then it's not only does it have good profitability, but it's a company that's poised to expand its services or its product line or its production. And so those are things that I look at, right? And so then I may venture to look at it for a year, right? And then I'll make my decision, you know. Now, I don't do that because I'm fearful. I do that because that's fun to me. That's, I mean, it's fun to me, you know, getting that information and analyzing, you know, that's fun to me. So that's why I do it, you know, and so it's fun for me to do that, right? So we talked about the close, you know, the price. What was the price of the stock when the market closed? And then the net change. The last thing that I do look at is the net change, the percentage return on the stock for that day and for 5 days and then for, you know, a year. And so those are things that I look at. I'm a bottoms line person when it comes to numbers. When I make major purchases, I'm not too overly concerned about what the price of an item is. I'm more interested in knowing what does it actually cost me versus the price. It could be pricey, right? But cost-wise, it may save me in the long run. So if something of value is a bit pricey, you know, the price do determine value. It really does. You know, don't think that because something is priced cheap that you've got a high value product or service. That's not how it works. The more pricey the product or the service is, the greater the value is associated with that particular product or service. And so I look at what does it actually cost me, right? So there's a lot of factors that go into play. Just to give you an example, I can shop Walmart for a TV versus BJ's, which is a group membership type of discounted place, not wholesale, but discounted, right? And at Walmart, the same exact TV could be selling for a little under $500, right? A little under $500. At BJ's, that same TV, because I have a membership, I might get it at a discounted price. And that discounted price may be, say, $400. So price-wise, I saved. Now, in terms of cost, what did it actually cost me? So I'm going to factor in my time. I'm going to factor in my energy spent. I'm going to factor in whether or not I drove there, how many miles did I drive to get there. All of these become a factor of what did it cost me, right? And then when I've made my decision of where I'm going to buy this TV from, right? I'm also going to look at, are there any benefits in addition to the purchase of the TV that is being offered? Like, for instance, does it already come with a manufacturer's warranty? And is it guaranteed? And what is guaranteed? What's covered? And am I able to also get an extended warranty that when the manufacturer's warranty runs out, I have a bit more time, you know? So all of that now speaks to what it actually cost me. Same thing with an automobile. You know, you might buy an automobile that the price is like $18,000, and you know, you say, hey, I can afford that, and you drive off the lot, and within 2 months, you've got some mechanical issues because there's not quality parts in that automobile. Versus you went to a Mercedes dealership and you were interested in purchasing a Mercedes Benz, and you got you a 300 series that was at $48,000. Price wise, yeah, that's a pricey automobile. However, the quality of material that goes into that automobile uh, makes it worth it, you know. Um, and so those are things you look at. And then now you have to also look at, okay, so now what does it actually cost me to own it? So yeah, I may have paid a higher price and got better quality service and better quality materials, but now what does it cost me to maintain it versus if I did get, and so those are things that, you know, you have to determine, you know, what you are willing to spend and how much are you willing to spend ongoing to maintain, right? So I treat stocks the same way, you know. I'm looking at price and I'm looking at now what is it going to cost me to have this, you know. And so part of the risk is that, yeah, the price can go down and I would have bought it at a higher price. So, okay, do I want to get more shares when the price goes down? More than likely, yes, I am. I'm going to get more shares. And then when the price starts to go back up, at what point am I going to say, okay, you know what? The price is up, it's high. I'm not going to buy any shares while it's high. I'll wait for it to go down again and buy more shares, you know. And so that's how I treat it. That's how I approach it. And I make it fun. I enjoy it. I spend maybe 15 minutes, 20 minutes a day, and that's it, 15 or 20 minutes, right? So let's talk a little bit more about some stock quotes, okay? So a better way to get a stock quote would be to do it online. And the reason being is because when you do it online, it's more dynamic. That means that it's still moving. You can see the changes. You see it in real time. There might be a slight delay, anywhere from a few seconds to a couple of minutes, but you get to see it in real time, and the price of the stock is more dynamic as opposed to reading it on a website or reading it in a magazine or in a stock article. I remember years ago, you know, you can always tell the ones who were stock buyers or stock investors, because when I used to ride the train and during the morning rush hour going to work, everybody would have the would have the newspapers out, and they would turn to the stock pages to see, okay, this stock, you know, and now I know what they were looking at. And before I had no clue. It looked so foreign to me. I was like, oh my goodness, how do they read that? A bunch of numbers, and I don't know what those numbers are, what they mean. Well, now I know. Now I know what they were doing, but they weren't seeing the price of the stock in real time, right? So I would say online, if you want to get a stock quote, what does a share of a stock cost you? Go online. That's a good way to get it because it's dynamic. You can do a Google search. Say for instance, do a Google search on Facebook stock, or do a Google search on Instagram stock. Do a Google search on Twitter's stock, and you just type in Google, how much is Twitter's stock? You know, and it'll give you a real-time quote of what that stock is currently trading at the time that you did that search. You can also visit a variety of websites to get stock quotes. You can go to, for instance, Yahoo Finance. That's a very good site to go to if you just want to get some stock quotes, or you want to educate yourself on stocks and you want to educate yourself on finances. Yahoo Finance is very, very comprehensive and very good at that information. You can also go to CBS Market Watch. That's another place that you can go. You can go to CBS Market Watch. I actually have about 4 or 5 finance and stock watch platforms that I go to from time to time if I want to just get an idea of what certain stocks are doing and what they're costing. CNN-FN, just, you know, for CNN Finance. That's another one you can go to, okay? If you want to get some stock quotes and you want to get them in real time, get some, you know, while they're dynamic. So this thing is not complicated. You know, people think it is, but it really isn't. Once you understand the terminology, you understand the characteristics of the stock market, You understand how to identify a stock. You understand how to analyze the performance of a stock. Once you get that, you know, with anything, the more you do it, the more you get acclimated to it, the more it begins to make sense. And so that's what I'm saying. You know, start somewhere and every day just do a little bit. Just do a little bit, you know. And after a while, it'll start making sense to you, and you realize that, hey, you know what, this thing really is not as complex as I thought it was. It's not as confusing as I thought it was. Once you know what you're looking at and you have a roadmap, it's just like getting in your car and you're going to a new destination you've never been before. It's good practice to have a roadmap or a GPS or something to guide you. And that's basically what you do with these tools. They become your guide, right? So the price that you pay for stock is not necessarily the same price that you'll get when you sell it. Okay, so you just have to be aware of that. And this is where, you know, again, when people prematurely got out of the stock market because the price of their stock was going down, and the price now was significantly lower than what they paid for the stock, and they're like, oh my God, I lost some money, I lost money. And then they turn around and they sold their stock, right? And so they sold their stock for less than what they purchased it. And so, yeah, they took a loss. Whereas if they would have probably more than likely held on to their stock, then they would have participated in the rebounding of those stocks. Because, you know, stocks do bounce back. You know, a few don't, but a good number do. You know, and when they bounce back, they usually bounce back well. And so then they would have not only made back most of what they lost, but then they also stand to make a little more, you know. And so so the bid, which is the price that you can sell the stock for, that's what a bid is. Okay, give you some understanding of some terminology. So when you see bid, that's referencing selling the stock. Okay, or also with, you know, buying the stock, you can bid a price. So the price that you can sell the stock for is the bid. The ask, excuse me, let me correct myself. The ask is the price that you pay in order to purchase it. So bid, you're selling. Ask, you're buying. And you can ask some stocks, especially through limit orders. You can ask to buy that stock at a certain price. Okay. The bid ask spread is actually the difference between the bid price and the ask price. So what did you pay for the stock versus what you sold it for? That's the spread. That number in the middle, that's the spread. And that's what determines whether or not you sold that stock at a profit or you sold that stock at a loss. The spread tends to be smaller in those better functioning stock markets. Okay, so there's not a wide spread that you would see. But again, what you want to see is that it is on the side of gains and not losses. Okay, so some very simple terms to understand and to know. Okay, so what I would encourage you to do, if you don't already have a investment portfolio, if you don't already have a online or a app that you can trade stocks through, I would encourage you to explore what is out there, see what appeals to you, what you like. And of course, if you come across something, you have some questions. Now, I'm not a guru at this, but I'm educating myself along the way as well. And if you have some questions, by all means, put your questions in the comment section, and I will get you the answer. If I don't know the answer, I know how to get to the answer. Okay. So this has been a wonderful session. I hope that you found that this information was useful and helpful to you, and that you would be willing to share it with those that you concerned and care about. Certainly, I ask that you would click the like button and certainly share. If you have not already subscribed to my YouTube page channel, I would ask you to do so. Please go ahead and subscribe. as well. That helps with viewership. And so thank you so much for viewing this session of Money Matters 101. Do enjoy the rest of your day or evening. Stay safe, be blessed, and peace.